Now we're unmuted. Okay, a little rusty right off the bat, but with that, we had our new video intro, so hopefully that's a little bit more exciting than just staring at our profit tracker with our system clock next to it, trying to up the production quality a little bit. But welcome back to another weekly, well, supposed to be weekly. Had a little bit of a hiatus due to a little bit of a vacation, but our weekly stock market scan, analysis, whatever you want to call it. I think we've got some really, really good analysis coming up because last week was actually a pretty busy week in the market. A lot to talk about. There was a lot that went well. We made money, which above all else, we hit our 1% return, which is fantastic. Did we underperform a little bit? But that's just because the market ran up a ton. And that's something that we'll talk about as we talk about some of the macroeconomic conditions in the market currently. How we see things from here on out as we head into the second quarter of the year, right? We have one quarter in the books. And we've got a really nice return. So let's talk about the strategy, maybe a little bit of a quarterly recap about how we've done, where we sit currently, what we could do better, what we've done really well. And then, of course, we will culminate the entire stream as we discuss what we've got for the upcoming week. And right now, probably about the lightest portfolio we've ever taken into a week in the market. And there's good reason for that, but we'll talk about why that is and what we have our eye on as we head into the upcoming short week because the market is closed on Friday, for Good Friday, I believe. So without further ado, we will take myself off of the screen and put the good info up there. But I'll join you right there in the corner again, as we normally do. But last week, good week, right? We took home a profit of $1,660 on the week. Now, in a vacuum, that's good. That's great, right? We will always be happy with the 1% return in a week in the market. However, the issue, quote unquote, is that we underperformed the S&P 500 and NASDAQ by about 2.5%. So what we want to look at is why did that happen, right? Is it because something we did poorly? Is it because of the market? What was causing that gap? And the biggest thing that was causing it is a little bit of a disconnect in between our position sizing and where we ended up at the end of the week. So if we go pull up Thinkorswim right here, we're going to go to the S&P 500 ETF SPY, and this is going to give us an indicator of what the market has done over the last 5 days. And as we saw from that first little screen we were on where the S&P 500 returned 3.45% in a week, that's a lot, and it starts to become a lot when you take a look at it in the context of the last few weeks in the market, right? Well, remember if we go to maybe, I think a 20 days probably a good way to look at this. The market was really dropping back off the face of the earth, even back mid-March, right? March 13th, which is just about a half month ago. It was down to 380.49 in pre-market, bounced up a little bit, was trading in this mid 380-ish range, which I think is fantastic range to invest in, and that kind of held true. But since then, really on March 24th, the market bottomed out at about 390 and then really, really went on a nice run up to 410 here. That is a very hot run in a very short amount of time. Now, that's not to say that that run can't be sustained or continued, but at the end of the day, the S&P 500, it's an ETF, right? It's a culmination of a lot of different stocks. So when it does start to run hot like this, we like to play it back down a little bit. And that's not to say it's going to come back down under 400 and not to say that it can't go back up above 410. But when we start seeing trends like this, typically the thesis we like to play is that the market is a little bit of a wave. In general, in the long run, it kind of skews upward, which is why we like to be generally bullish in our positions. But if we go to the 1 year chart right here, all of a sudden RSI is starting to run a little bit hot again. Now, it's nowhere near the number that we want to see in order for in order for us to be fully bearish on the market, right? We love to use RSI as a dictator of what we want our positions to look like going forward. And until it gets up into the high 60s, 70-ish area, we don't necessarily want to touch a thing. And it still isn't there, right? I think if we see a further run, up towards this pre-established resistance level of 415 to 420-ish, and then RSI on a 1 year basis would in turn hit the high 60s. That's when we really want to start playing a reversal. But right now, this is nothing more than just a typical little jump. I am a little bit bearish in the short term about where we might go from here, just simply by the virtue of the fact that we've run up pretty quickly over the last 17-ish days. We've saw on a 180-day basis. There you go. You'll see you'll see an RSI measure that's a little bit more reactive to short-term moves like we just saw, right? So we saw this really nice short-term run from March 28th up until March, what was last Friday? It was March 31st, right? A little 3-day run in the market. So, what do we look at when we see the 180-day chart, right? We see that there potentially could be some resistance around 415, very similar level that we were looking at before. And again, while I like to use the 1-year RSI to dictate my decisions, it's always helpful to use additional data points as well. And the 180-day RSI is another good one to leverage. As you can see, it's currently sitting at 71.75, right over here on the right side. So we generally want to be a little bit bearish. So let's quickly run through what we did last week and talk about why, I'm okay with this. And again, in a vacuum, all we try to do is get 1% per week. Reason being is that 1% return compounds very, very nicely into a long-term gain. And we basically accomplished that, right? We took home 0.91%. And if we do that every single week, irrespective of what the market does, I will not have a complaint in the world, right? This is one of those quote-unquote good problems that we like to have. It's like, yes, the market did run up a bunch, but, we're making money. It's fine. And if we look at our summary so far year to date, we just finished out the quarter with a return of 7.73%, which is fantastic, right? Obviously, there's 4 quarters in a year. If we do this roughly 4 times and compound that, we're looking at like a 30-ish% return on the year, which I'm going to be fantastically happy with. It's probably a little better visualized looking at this performance against the S&P 500 and NASDAQ chart that we've got up here. Remember February, back when NASDAQ was ripping to not new highs, but, ripping to highs on the year 2023. And we're saying, hands off the wheel a little bit. It's running up too hot, too quick. It's going to pull back. This is the exact same type of, impression we're getting right here. And in fact, this is the S&P 500, which we're outperforming on the year. QQQQ is tech, which tells a little bit different of a story, right? If we go to the 1 year, there you go. It's at 68.47. So tech in particular looks like we could be looking at a little bit of a reversal in that area as well. But now the question is, where could we potentially get that reversal? We see that there's pre-established resistance right around this 334 level. So that's probably where I would have my eye on for a initial reversal on tech specifically, right? Nothing too crazy from a market perspective that I want to play. But if we start pushing up to this mid 300s level, this is absolutely going to be above 70. And again, why do we love RSI as an indicator so much? Because really there's only one instance in the past calendar year where this thing has run up above 70. And in that instance, right, it was right around the beginning of February. And it almost immediately fell back down below 300, right? And it's not to say that this is going to crash back down at any point, but when we're selling options, right, we're selling premium. We set these price levels that we want the stock to either stay at or below. So even just a leveling off or a slight move in our favor is going to give us the profit that we're looking for. So great indicator to keep your eye on. It's getting very, very close on the tech side. S&P 500, not quite there yet. For whatever reason, that didn't work when I typed it. Yeah, not quite there yet on the S&P 500, but keep your eye on that trend, right? If we go to Market Watch, we've got all of our S&P 500 sectors pulled up here. If we sort those by RSI, that tech ETF, again, it's getting a little bit overbought into the 70.26 level, right? If we go to XLK specifically, that tech ETF, you'll see over the last calendar year, there really aren't any instances of RSI getting above 70. And as of right now, it currently is above 70. So this is a setup that we have not seen from a bearish reversal perspective. We haven't seen this in the last calendar year. And again, last time it happened, right around there, you could see it. It briefly goes red. So I think I may have misspoke there for a second, but it briefly goes red, and same exact trend as we saw with QQQ earlier. Those things kind of track very similar, things and ideas. So being bearish on tech is probably not the worst thing to be in the world, right? So how would we want to play that? And the answer we'll take a look at when we talk about upcoming trades for next week. So potentially, as we even look at that just now, XLK, anytime any of those sector ETFs get overbought or oversold, that's definitely something we want to keep an eye on. So let's highlight that blue as a potential trade for next week and move into quickly top to bottom, running through what we've done. So really, really clean week. And the reason I say that is that we didn't really lose on any positions, so to speak, right? You'll see a little bit of red here on a firm where we lost $700 on shares, but we collected $530 from the 10.5 strike calls we sold. We collected $380 from the 9.5 strike calls that we rolled down to. And then finally, collected $235 from the 9.5 strike puts that we sold. So it netted out to a $445 gain last week on Affirm. And the great part about that is, yes, at the end of the week, it did run back up to like 1127, which is kind of crazy 1 week price movement, which is why this stock has such good premiums. But look, on March 28th, on Tuesday afternoon, this thing was at $9.11 at the bottom. So we had to play a little bit of defense. And I think walking through the process of what we did on this one last week is going to be a great way to illustrate how to play these things when they move against you. Because yes, Affirm did go all the way back up to 1133 at the end of last week, which is great because it's nice and easy. We take home $445. It doesn't take too much effort. But the what if that we always want to keep in the back of our mind, right? We want to, that disaster scenario, right? What if it keeps getting worse? What do we do? And this is a good example of that. So we started with the shares, $10.20. We sold 10.5 strike calls. Our initial break even on that's going to be the 10.2 minus the 0.63. So, 10.2 minus 0.63. 957 was our initial break even. And spoiler, by the end of our maneuvers, so to speak, we got our break even down to 929. So we know that 957 was that original break even price, right around here. And that's a perfectly acceptable place for us to be, right? We know that anywhere above this red line, we're going to be making money on a 1 week basis. It's a very simple trade to pull off, in terms of plain English. So that's exactly. So as we could see from that chart that we looked at just a second ago, it did break below that. And we always want to wait when it gets down to that level, right? Because really happening, there's one of two things that could happen that we talk about every week when the stock gets down to our red line, our initial break-even price. And that's one, it could kind of level off or bounce back up, in which case, perfect. It's going to bounce back up above our break-even price. We're going to be back in a position where we can make money on a weekly basis. All is good and well, and we don't have to lift another finger. But option two is it could get worse. And especially when you have this price breach on like a Tuesday afternoon, there's still a lot of time left in the week on a Tuesday afternoon for things to get a lot worse. And they did get worse, right? As it went down to 911 at the bottom on Tuesday, as we talked about. So to manage that, we did two things. And the first of which is going to be, actually, let me take a look here. Yeah, the first thing that we did was average in with these 9.5 strike puts. So we want to leave ourselves the flexibility to increase our position. That's a key tenet of the strategy that we're running in this market. So we left ourselves that flexibility. We averaged in, right? And with that, since we had 1,000 shares, selling 5 of these is, kind of not necessarily doubling down, which we do like to do sometimes. But again, it was just a Tuesday afternoon. Things can always get worse. So we sold a half doubled down position. I guess that's probably not the most eloquent way to say it. But we went from what I would consider, 1,000 or 10 contracts worth of a position size up to 15, with the intent to potentially go up to 20 if things get even worse. So since it's not quite a double down, it's not going to be a cent for cent reduction, but it's going to be a half cent for cent reduction, if that makes sense, right? So if we had sold 10 of these and doubled down to 47 cents, it would have been a 47-cent reduction, but we sold half that. So it's a 23.5-cent reduction of our break-even price, right? So we go from that break-even price of 957 to a break-even price of 934, which is down here. So there you go. One nice and easy move with a nice, easy addition of the 9.5 strike puts, and all of a sudden our break-even price goes from here to here. And in the scheme of things, yeah, this thing moved about $2 in a range of $2 on the week, which is a very, very large move in a short amount of time. But you have to remember, the stock could go up, it could go down, it could be equally volatile in both directions. As we lower our break-even price bit by bit by bit, one, we still had a little bit of ammo in the back pocket where we could have added 5 more contracts and gotten it further down. But two, again, things can always get worse, so we want to kind of hold off, right? Because yes, it could be volatile in both directions, and we could see a move like we saw at the tail end of last week where it moved back in our favor and we were good to go. Or we could see a move where it gets a lot worse and we would have regretted scaling further in. But in order to kind of, nullify a little bit of risk here, when this thing was trading down at 911 or at, a little bit closer to 9, the odds that it got back up to 10.5 were frankly kind of small. And we knew that we would hit max profit on this position that we added if it finished above 9.5. So as a way to kind of mitigate some of that risk, we actually rolled these 10.5 strike puts down to 9.5 for a 28-cent credit, meaning that we closed the 10.5 strike calls for 10 cents. And then we opened the new 9.5 strike calls for 38 cents, meaning we sold these for 28 cents more than we bought back the 10.5 strike covered calls for. And in doing that, that 28-cent credit is a direct reduction to our break-even price, right? So our break-even price goes from 9.30. What do we have this thing at? 9.34. You subtract 28 cents. All of a sudden, your break-even price goes down 28 more cents. So it's down in the neighborhood of somewhere around here. So there you go. Two quick and easy trades. Now, the trade-off here, because in exchange for aggressive decrease of our break-even price, is that our upside is now capped a little bit, right? We previously had upside on the shares up to 10.5, but now since we rolled these down to 9.5, we only have upside down to here. So it takes away about $1,000 of upside on the shares, but good problem to have, quote unquote, right? Because if that upside is realized, which it was, one, we know that these 9.5 strike puts that we sold are going to hit max profit for $235. We know that we're going to be getting, that premium from the covered calls. So combining that cash secured put premium with the premium from the two covered calls, the covered calls we started with and the covered calls we rolled down to, that's over $1,000 of premium. So while Affirm did bounce and we had those shares called away at 9.5, which locked in a $700 loss on the shares, the flexibility in our position moved our break-even price from here to here and then down to here. So while, yes, we're not going to have this enormous gain that we may have had we just held on to those shares and let the market play its course, because we never want to be in a position where we're trying to count on a move from $9 a share to $11 a share in 3 days. That's just not good investing. That's not smart investing. And if you're putting yourself in a position where you're counting on a 20% move in your favor in 3 days, you're going to be unsuccessful more often than not. But if you put yourself in a position where, hey, we knew that with the amount of money that we had set on the side, we had a couple moves where we could effectively decrease our break-even price and put ourselves maybe not so much in a position where we make a fortune if it comes back up here, but in a position where we don't get crushed if it either stays down here or continues lower. And our main philosophy is we want to compound a lot of these smaller winners. So even though this is only a $445 gain, Affirm is really the only one that moves sharply against us. You combine that with Peloton, right? You combine that with what we did on Delta Airlines, and all of a sudden these trades start to add up. And that's what happens. We take home, $1,600 last week, $3,000 the week before. We talk about Affirm because it's the one that moved against us the most, and there's the most to learn from that. Because it's very easy to make money and win a trade. What's harder to do is, follow the process, understand in the moment what to do, and stick to that HT wheel process we have outlined and turn a loser into a winner. And I believe that's what we've done with Affirm. And yes, you may say, oh, if we held on to it, it bounced back up to like 11.27, we could have made more. But in the scheme of things, let's remember overall where we first started playing Affirm. And the answer is at the beginning of March at 13.5. So even after this big rally back up to 11.27, Affirm still isn't close really to back where it started when we were trading it, right? It's still down about 17%, yet we're making money on Affirm overall now. And this is wrong, right? We got these shares called at 9.5. This needs to be updated a little bit. But we are now in a position where have lost $35 on Affirm on this trade, despite the fact that the stock has dropped 16.52%. And the great part about this is, yes, in hindsight, it's easy to say, oh, it went back up to 11.27, so, we really capped our gains. But we would have had this result anywhere from 11.27, where it finished at, or 9.5. So we could have been in a position where Affirm had still dropped 30% on us in a roughly 4-week period since we started the trade, and we still would have broken even. So yes, we didn't quite get the big benefit of the upside jump, but the benefit of what we did is that we still would have been fine on a really, really large dip or a sustained dip around that 9.5 level. And the great part about this is it's not the end of the day. Just because we got those shares called away doesn't mean that trade's over and we're over and done. Yes, we broke even on a 20% move against us, but we could just go right back into it next week, and that's exactly what we did. We went to Affirm and we sold 5 of the 11 strike puts and just started the thing over. But that's an example of really the one thing that kind of moved against us, yet still, in the end, turned out our way, right? Patience is so important in the market. Just because things look bleak on a Monday or a Tuesday doesn't mean that they can't turn around in your favor Thursday or Friday. But by the same token, just because something is going poorly on a Monday and Tuesday and turns in your favor doesn't mean that a poor Monday and Tuesday can't turn into a worse Wednesday and Thursday. So, these are the weeks we quote unquote regret some trades, but our types of regret are we could have made more money on top of what we already made, as opposed to the regret of, oh no, I'm stuck in a bad trade, I'm losing money, right? How many losing weeks have we had so far in 2023? The answer to that question is three. We had one where a few stocks really got away from us, which I think could partly be chalked up to a little bit of bad luck, but that's going to happen to you in the market, right? Yet overall, through how many different weeks have we had? We've had 13 different weeks so far in 2023. We've won 10 of them. We've lost 3. We've made $13,509 and finished up the quarter with a 7.73% return. So while we still are trailing NASDAQ by a decent bit, I think we can kind of rest assured in the sense that NASDAQ is not going to go up 16.77% every single quarter. That would be insane. And two, the S&P 500 just had a 7% quarter. We know that the average return in the S&P 500 on a yearly basis is between 9 and 10%. Yet it almost hit that in one quarter, yet we're beating that. And the great part is we're kind of doing that in spite, right? Well, remember in January, we had some bearish positions that actually got hurt before they finally started profiting. And in fact, some of our positions were so far into the money from our bullish positions. And, we had these SPXU and UVXY hedges that a run this high actually kind of hurt us. So we're not making these returns because of the bull market. And in fact, we probably could have made a little bit more money had it not gone up so much due to some of those hedges. But that's just an important concept to keep straight. Good comment from the YouTube. Got a question saying, just found your channel. How is our SPX 0 day going? And the answer to that, a good segue into the recap of this next position, is we've kind of moved away from the 0 day SPX a little bit. Now, is that because I don't think it works? No, I think it works actually very well. And if we go back to these SPX trades, you'll see that we had a really, really nice thing going on SPX. We had some really, really nice profits. We made some adjustments to the strategy that made it more profitable. We had some 0 day condors going that were also doing very well. But personally, the 0 day SPX trades require a lot of management, a lot of keeping your eyes on the market, understanding when to get in, when to roll. So we moved away from those a little bit because at the end of the day, we were making like, 3-ish hundred a week. We were kind of targeting that amount. Some weeks would be better, some weeks would be worse, right? But the average I think we were making was about 300-ish a week. So what we moved to are actually these XSP strangles. Why do I like these a little bit better? The answer is one, there's a little bit longer of a time frame, right? So, I work a full-time job. A lot of people in the chat work full-time jobs. And the great part about option selling and the strategy that we'd like to implement is the fact that you don't need to be glued to your screen. With the 0 day SPX strategy, you kind of need to have your eye on the market at all times. So we had a few instances where I may have missed an entry, I may have missed an exit, which, if you have the luxury of time to be able to sit in front of the screen and say, okay, I'm going to do this at this level, I'm going to do this at this level, you can be very successful with that. However, I was running into situations where I didn't, and then, by virtue of me having a group that is following my trades, I felt that I was doing the group a little bit of a disservice by not being able to put that kind of time in to watch those. So what I've done is switch to a different position, which has a little bit longer of a time frame, much easier for us to manage, and kind of works the same from a profitability perspective. And that answer is the XSP strangles. Now, we've had some of these tested, we've had some of these blown out. This needs to be updated because we've made a lot of this money back since then. But we had it going very, very well. We've seen the good side of it. We've seen the bad side of it where we get completely torched on one and we lose $1,000 in a week. But so far, I'm really happy with where this has gone. And some of those lessons that we've learned, for example, in the week where we got torched, our big look back takeaway is that, hey, we were actually profitable in this position at one point. Why didn't we take that profit? And this past week is a great example of us learning from that, right? I believe it may have been on Tuesday. We looked at this and said, hey, our max profit on the trade is $346, which of course is never guaranteed until you get to Friday afternoon. We were in a position where we were able to buy that, buy the strangle and close it out for $1.43, meaning we take $203 of profit in about a day and a half on a 5-day trade, which would have brought home $346. And when I say would have, that's not guaranteed, right? It would have had to stay between that range. What's great about this is we took our $203 of profit, and if you look at XSP, it actually finished the week at 410.93. So we know that that 402 strike call would have been worth about $9, meaning that that strangle would have been worth 9. So if we had gotten greedy and not taken that $203 of profit, it actually would have turned into a $554 loss on the trade. Now, this is a little bit reassuring because one, we did a great thing. We learned from prior mistakes, and we have a winning trade, which would have been a losing one had we not acted. And two, you have a really big move in the market, yet the loss would have only been 554 if we screwed up and didn't touch it at all. So moral of the story, close these things early on Monday and Tuesday if you can get over half of max profit, because you can always enter in again for the following week. But again, when you keep that position size small, in reference to the size of your account, even if you do mess up, you do miss an exit, you do miss an entry, yada, 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 and things move against you, shit can't hit the fan, so to speak, too badly, right? It would take a really, really big move in the market to have anything too crazy happen. But I'm happy with how that one turned out. A few other notable trades are AMC, where we sold the 4.5 strike put for 12 cents. And AMC last week, and then GameStop 2 weeks ago, right? Last week on AMC, we made 120. 2 weeks ago on GameStop, we made 110. That's $230 of profit off very similar moves, which required very little effort on our parts. Very similar setups. If you look at AMC, and the key thing about these trades is that they never really were in danger, right? So anytime we see a big spike upwards, and this spike in AMC, as we called out in the Discord, was caused by an Amazon takeover rumor. And whether or not that rumor is true or not, I don't really care, because what you see right here is this big spike in price accompanied with a spike in implied volatility in AMC. So that's exactly what we like to look for in our little IV reversion type trade, right? Good news causing a spike in implied volatility, good news causing a corresponding spike in the stock price. And the third element is that we want to be able to find a little bit of a base where we could sell the options at. And the answer, right, you could see on Tuesday it went from 465 up to 550 at the peak. So that base that we would want to sell at is at 465 or below. So luckily, thanks to that spike in implied volatility, we're able to find 4.5 strike puts for 12 cents of premium and set up a trade where, even though there's this big spike that we missed out on, and oh no, you missed the news, because of that news, because of the spike and the fact that it spikes so sharply, because of that spike in implied volatility as well, it allows you to sell this level right here at 450 and make money. 12 cents on a 4.5 strike put is a 3% return on risk. That's 3% in 3.5 days. Very, very big number there. And it allows you to make money on that so long as it doesn't fall all the way back down. And why I made that comment saying, I don't care if the rumor is true or not, because even if the rumor is false, what's going to happen? It's going to erase that green candle, and it's going to fall where? It's going to presumably fall right back to where it started before the rumor and just erase those rumor-related gains. And the great part about that implied volatility spike allowing us to sell below that initial level is that, yes, it's kind of risky to play news, but if that news goes away, the idea is that it still doesn't get back down to the level you sold. You take advantage of that, and it works great. We can pull up that GameStop chart. We're going to have to go to the 20-day. You'll see a very, very similar idea. Now, this was a earnings-driven spike, so a little bit different than kind of an intraday news piece, but same general idea, right? 18.5, we were able to get 15 cents. That's still 1% ROR for a very short period of time. The 18.5 level is right around here. So not quite back at the base it took off from, but very close-ish, right? I think GameStop was up like 40%, fell all the way back down, and correspondingly, you see implied volatility fall back down as well, which really, really sucks the premium out of those deeper out-of-the-money options. So you've got a couple things going for you. One is that, if it levels off or bounces back up, it's going to kill implied volatility. You can see that demonstrated right here as that blue line moves further and further down. But thanks to that move, thanks to the leveling off and the death in implied volatility, so to speak, we're able to have that premium sucked out, make a quick 110, identify a similar pattern the next week, make 120, and all of a sudden, that's 2 quick trades where you make $230, and I think it took maybe 30 seconds combined to open those trades and let them work their magic for us. So great setup. We always want to keep an eye on those types of trades in the future. But that kind of rounds out what we did last week. I don't want to spend too much time recapping because we didn't get a chance to recap this, but 2 weeks ago we did even better and it was fantastic. But we're on a roll right now. So on a 2-week basis, right, that's a profit of $4,679. and we're going to hope that we could keep it rolling, right? The general idea that we have is that the market's a little overbought. We can look at futures right now and see that they're already starting a little bit red, so not a bad place for us to be right now. But again, S&P 500 ETF SPY, 1-year basis, that's the TA metric we like to look at, 61.97. So not quite up to 70 where we'd want to be, full on bearish in our portfolio playing a reversal. But definitely want to look at some more neutral, delta weight, delta neutral positions instead of going all out bullish like we normally like to do. So what do we have set up for next week? We know that Affirm got called away from us. We know that Peloton got called away from us. And Peloton was great, right? We were able to scale in with the 9-strike puts, and our initial trade hit max profit as well. We made $940 on it. It was fantastic. And we could update this as well to reflect that we got it called away at 10. Another situation where, look, we broke even on a trade where the stock dropped 11.06%. And we had that protection all the way down to 10, so it could have dropped 21.57% on us, and we still would have broken even on it, right? Breaking even was kind of the name of the game with how much these moved against us, right? We could have withstood a 30% drop on Affirm and withstood a 21% drop on Peloton. So that's a great place to be. We basically broke even on those two, so we just start right over, right? What we were able to get into at the end of last week was 5 more Affirm at an 11 strike. So if we go -5, we're going to populate this as we speak, so bear with me. That's going to be a 4/6 expiry 11 strike put, and we sold that for 51 cents. So there you go, 51-cent trade price. And then very similarly with Peloton, right? We've got 5 of those Peloton contracts. They're going to be 4/6 expiry, and I believe we did 10.5 strike puts. Correct me if I'm wrong. It was an 11 strike put. 11 strike put on Peloton. So let's update that really quickly. And those are our two, and we got a 28-cent credit for that. So those are our 2 bullish positions, which again, very, very light portfolio headed into the following week because we have these 2 positions, and we can kind of sum these up to see. Nice spelling right there. There we go. $395 of potential max profit off of the bullish positions, which I cannot emphasize enough is nothing. Now we have 2 more positions that we carried into next week, as you can start here with SPXU and UVXY. So what we did there is we started the way that we normally like to start with the, even though these were hedges, we still want to play them the way that we normally play, our HT wheel type strategy. So with SPXU, right, we start with that half size position. Whatever happens, happens. And it moved against us, right? And that's one we're happy to have move against us, because if this is deeply red, it means the market is deeply green, and we're going to make a decent amount of cash that way. So what happened is we were assigned 500 shares of XPXU. These are going to be shares, and we were assigned these at 14.5 minus 1.02, right? That's going to be that 14.5 strike we sold, net of that 102. So basically 1348 is where we effectively own these. So if we go Google Finance, pull in SPXU, this should say 1348, boom. So we've got those shares. So what's the first thing we want to do when we get those shares? The first thing we want to do is we want to cover them. And we can kind of do some scratch work over here, right? We can call this XPXU break even. I literally cannot spell. I woke up from a nap like 15 minutes before we started the stream, but promise these spelling skills are normally a little bit better. So from last week, we know that our break-even price was that initial position, right? We started with the 14.5 strike put. We sold it for 26 cents of premium. That's a 14.24 break-even that we have on the shares that we've been assigned. But look, it's at 1348. We've got a lot more work to do from there. So the first thing we want to do is cover those shares by selling 5 SPXU 4/6. We'll call this XXC for right now because we want to sell covered calls. But what strike do we want to sell? So there's a couple different ways to look at this. The first of which is, look, we have a 14.24 break even. Let's potentially sell 14 strike calls, because if we look at the 14 strike calls, they're selling for 14-ish cents. So that would get your break even down to 14.1. But again, that puts you in a position where if it ramps back up, you're still not quite breaking even. And the benefit of starting with these half-size positions is that we can increase position size. So that's exactly what we did. So before selling the covered calls, I want to be mindful of the fact that I'm increasing my position size, right? We sold some SPXU 4/6 13.5 strike puts, and you could see these right here. and we sold those for 23 cents of premium. So 0.23. And we know that when we double our position size, right, we had 500 shares. We saw 5 more contracts to get to like a 1,000 share, 10 contract size position. So we'll call this the double down. And it's going to go from 14.24 minus 0.23 because every single cent we get on the double down, remember, is a cent for cent reduction in our break-even price. So now we're sitting at a 14.01 break-even price, which is, okay, looking a little bit better now. But to compensate for the fact that we've got this really aggressively sold 13.5 strike put, and why do I say that this is aggressively sold? Simply because SPXU is basically at 13.5. We're selling that right at the money. So to compensate for that, what I wanted to do was sell that covered call right at the money and kind of create, normally we go for a covered strangle, but I'm going for a covered straddle where the covered call and the covered put are at the exact same price. Reason being, we got 37 cents on that. So we sold this for 0.37. So again, it's a covered straddle as opposed to a strangle, but same idea. We sold the 13.5 strike call, and we know that this, covered call, we'll call this, is going to be a 37-cent reduction in our break-even price. So this is where we're currently sitting at, a 1364 break-even price on SPXU, despite the fact that we started it with the stock above 14.5. And we could better illustrate this over here. We started with it at it was at 15.17 last week. Yet we initially had a break even here. We lowered it to 14.01 and then 13.64, right? So we started it last week with the 14.24 break even price. And then as of the end of the day on last Friday, we had a 13.64 break even price, which is all the way down here. So all that to say, we take this thing 1 week at a time. And if we go look at this on like a 180-day basis, this does have a lot of volatility on it, but it's also a stock that has been decently, rigid as far as following these RSI rules. It's almost back to oversold. This thing very, very rarely gets oversold. It happened one time in the last calendar year, but the last time I got close was again beginning of February, and then it settled down and came back up after that. And the great part about this one as well, for those of you who have been following along with this trade, is it's an Ultra Pro short ETF of the S&P 500. So we're worried that the market's getting a little bit overbought. Now we've scaled into this bearish trade, which we're going to benefit from if the market, falls back down. And we're going to benefit from that. And, max profit next week is if this gets up to 13.5, those shares get called away at 13.5. We collect that 13.5 call premium, and then we collect the 13.5 put premium as well for $310, which again isn't a ton of money, but we've started this very safely, and we're just going to continue to play it the way that we normally should. And now that takes us to the next position that we're rolling into next week and doing the exact same thing with. It's UVXY. And UVXY is similar in the sense that if the market goes down, this stock normally pops back up, but a little bit different in the sense that this is measuring volatility in the market as opposed to just being a bearish ETF or something like that. Over the last 20 days, we've seen a big spike in implied volatility that has since, teetered back out a little bit. And a lot of that spike is keeping RSI a little bit elevated. But we started small on UVXY, and we're going to, play the game we normally play. What's tough about UVXY is over the long term, it's going to go down. That's just the way that this is structured. It's an inverse ETF playing off of volatility in the market. That's just what's going to happen. So what you want to do is not so much, potentially get bullish as it's running up, but when it finally pulls back down, that's when you want to start to get back in and potentially bullish on it so that you have another type of hedge. So let's insert a few rows here and run through a very similar exercise as to what we just did. Right, so we now have 500 shares of UVXY, and we're going to have these shares at 5.5 minus that 85 cents that we see right here. So we've got these shares at 465 heading into the week. We could use that Google Finance function again to pull in UVXY's price, pull these formulas down, and boom, we are ready to go. So we know that we got to sign those 500 shares. We did the exact same thing, right? We know that we want to cover these shares with the 4-6, and again, we'll call this mystery strike for now, 0, 0. But we also know that we want to double down on our position, right? So we've got this SPXU break-even thing that we just laid out right here. Let's do a very similar calculation for UVXY. So we started the trade last week when our break-even price was that 5.5 strike, 5.5 minus the 41 cents of premium we got for it for a 5.09 break-even price. And again, UVXY started last week. If we go pull up that chart again on a 5-day basis, it started last week at like, 550-ish. So that was kind of dead at the money. Again, we started with a break-even price at 509. So that was a decent place for us to start out at with the half-size position. So how do we take that 509 break-even price we had last week and kind of try to save the position, so to speak, and follow the process? The answer is, first, we're going to use that double down. We know that we want to use that double down. We saved some money for it. We started with the half-size position, so we can use the double down. So let's take advantage of that flexibility that we allowed ourselves. We're going to do that with the 4.5 strike put for next week. And if we take a look at what we sold, what we're going to have is that 4.5 strike put, and we sold it for 16 cents of premium. So with that double down, our break even goes from 509 minus 0.16 down to 493. And then we know that we want to cover those shares. So what we were able to do was sell a 4.5 strike call for 21 cents. A very, very similar idea where instead of necessarily going to the covered strangle, we go to the covered straddle. Accomplishes a similar thing, gets you a little bit more premium on the call and put side. But the downside is it kind of limits upside. So with that straddle, we sold a 4.5 strike call, and we did so for 21 cents of premium. So there you have it. So that's going to reduce our break-even price by 21 cents and take us down to 472. So we go from here down to 472. Great progress for 1 week. Now, we are capped at 450 because of where we sold these, so neither of these two trades are going to result in a gain right off the bat. However, both of them, if they go the way that we would like them to go, are going to get us. This will get called away at 4.5. They'll both, UVXY will recover $110, which maybe isn't a huge amount of money, but then SPXU will recover a little bit more. And all of a sudden, if we have a bearish move in the market and the market turns around, volatility pops back up a little bit, we're making $420 off of that, which is a decently nice place for us to be. But now that kind of begs the question, we have two bullish positions. We have two bearish positions balancing those out. What do we do now? I know that I mentioned I want to be a little bit more neutral as we head into next week because I don't want to be just all out bullish, because if you get a little too comfortable in a market like this, it can and it will reverse at some point against you, and you are going to be caught with a loss after not necessarily fully benefiting from the gain of the run up. So we always want to kind of be playing both sides when we see, look, on a 180-day basis, 70.1 RSI on the S&P 500. Be very careful with that. On a 1-year basis, still a little bit of room to run, but we remember looking at the beginning of the stream when we looked at the different sectors of the S&P 500, we'll see that financials still oversold. Those are banks. I don't necessarily want to take on risk that I don't need to take on. And to me, that's what those banks are representing. But with the technology ETF, we see that it's 70.26. Anytime we see any of these individual sector ETFs go one way or the other, we like to play them the opposite direction. So XLF on a 1-year basis, why is that looking? It's XLK. That's why. That makes more sense. I was going to say, I didn't expect to see that. But boom, we're looking right here at this position where we previously had a little bit of resistance. We see that, volatility's dropped off a little bit. That's just going to happen when the market goes on a bit of a bull run. However, RSI at 70.26, it's overbought. The last time it got overbought, beginning of February, when it leveled out and then fell back down. XLK, very similar basket to QQQ. We mentioned on QQQ, we maybe want to wait until it hits 300s. So there's potentially a little bit more upside in tech. But from XLK, I think there's probably some good stuff we could do here. So let's take a look at the strikes that we have for the coming week. And honestly, these aren't terribly inspiring. The good news about this is it's an S&P 500 sector ETF. So it's not going to do anything too crazy to you, right? There's a range, from October of 2021, all this volatility resulted in a range between 120 and 177, right? That's like a $57 range. So it's not going to be anything crazy like if you look at the 3-year chart of something like an Affirm, where we would never want to sell a naked call on something like this. But with XLK, I made the mistake again. It's probably a little bit safer to do something like that. So the idea would be that you start with like a 151 strike call. You could potentially sell that for $150. Sell that naked. It only takes, 3-ish thousand of buying power. And again, if that's not something that you could do in your portfolio, just ignore me. Or you could turn it into a spread where you sell the 151 These are kind of cheap behind it. You could buy that behind it and still give yourself potentially some profit, right? If you want to look at this as a vertical spread, the 151, 153 looks really nice. You get that 110 credit right there. And instead of, actually, I really like that spread. Anytime the premium is a little bit lower, you kind of want to take advantage of that on the back leg, right? You can get 110, and then your max loss is 90, which would lead me to believe you're probably not going to get filled at 110, but something about one probably isn't necessarily out of the question going for that 50-50 type return. And the great part about that, again, is that, if it runs up, whatever, right? We could potentially take assignment of these shares short, and we would have assignment of those short at that 151 short leg plus the $1 credit we get. So anywhere below 152, that thing makes money. Anywhere below 151, it hits max profit. We're banking on a little bit of a reversal right there, and I think that's a decent way to play that. So I love the idea of potentially looking at something like a 4-6, 151, 153 strike call. And again, this is going to be a bearish trade. We want to be mindful directionally of where all these things are going. So we have one bearish trade here, another one, and another one. And then we have a bullish trade here with the firm. And let me make that green really quickly. And then so we've got 2 bullish trades, 3 bearish trades. Let's balance it out, try to find something else bullish. And the way that we do that, we go to the scan. We potentially could start this off by looking at the high ROR puts without earnings scan, just kind of look broadly at what we've got going on, that is. And that's going to give us the highest premium options in the market. And there are some insane options right now, starting with Zim, where these are paying 39% ROR. I would imagine that Zim's probably about to pay their dividend, which is why this is the case. So I think if you go to single, you look at these, yeah, it's going to be way skewed here. Anytime you see something like that where the premium isn't necessarily matching the call premium at similar strikes, something is up. I can guarantee you that they're about to be paying like a $5 or $6 a share a dividend right here. So that's what's going on right there. Leave that one alone. That's kind of one of those false positives. BBAI, kind of interesting, 13.64%. Not saying this is a good one. Most of those are not, but could potentially be worth a little bit of a look. And we see that last week it was trading around 2 before running up to 250. In this one, you could maybe try to convince yourself to play the numbers game on it a little bit. Typically, if you look at a chart like this, decent precedent for it to go back up a little bit. That 2 level looks pretty strong. It was holding that 2 level from March 21st onwards. And again, if we sell an expiry on Friday, expiry for Thursday, the market's closed on Friday. It's a 4-day trade. Yes, this is a little riskier, but maybe if you get a fill for something like 10 on a 2-strike put to give you a 190 basis, 190 is not a bad place to be living on this stock, but I do potentially hesitate a bit to say, let's go for 30 cents on a 2.5 and get up here to 220 basis. That's potentially on a risk perspective where you start to lose me. But the great part about some of these smaller ones is, yes, while they could be super, super volatile, is the fact that even if you sell 10 of these and you want to set yourself up for a $250 profit, the position sizes themselves are very, very insignificant. So while you're chasing a little bit bigger of a risk, you maybe necessarily can't lose as much as a typical trade because a 2.5 strike is very, very small. And at the end of the day, worst case scenario, you've got yourself set up with shares at $2.20 a piece. And then you go looking at the following week, you try to sell some covered calls and you just keep it moving from there, and try to get that basis down near 2 for the week after that. So could be an interesting one to maybe just sell like 5 of these where it's a very, very small muted position. And if it really starts running against you, you only end up with like $1,000 worth of shares, while you still give yourself like 3-figure upside to $125 in max profit. I don't hate that idea. And the good part about this as well is trades like this are going to be a little bit more disconnected from the overall market. It scares me a little bit from a longer term perspective because this thing can and will go back down to 1-ish. And that'd be a pretty quick move to try to fight against. But look, we have these options every single week. There are strikes at 50-cent intervals. I don't hate the idea of maybe throwing a little bit of risk on to give yourself some excitement for the coming week here. So we could potentially add a few more rows here. Let's get this formula copied in over here. And let's maybe try just 5 of these. How about BBAI 4-6 2.5 strike puts and rip those for about 30 cents a piece. That's the plan. Again, this is the plan. We may wake up Monday, this thing is run a ton. We may wake up Monday and this thing's falling back down. We get an even better price, but that's kind of the plan. And I don't really want to consider this a bullish or a bearish trade. You may say, well, this is obviously a bullish trade because you're playing the stock to go up. But I really want to evaluate the bull versus bear in the sense of, okay, if the market goes up, which position is going to benefit? This thing just behaves erratically, completely independent of the market, so I don't think it should really be considered if you're evaluating your positions from like a bull versus bear perspective. And it looks like AI in general must have had a crazy move at the back end of last week. I mean, that is insane from C3 AI. That's a massive candle at the back end of last week. You've got this thing at a base of 20. I mean, how far down can you go and get premium here? The answer is, yeah, not as far as I would like. 26 is where you get that 1% ROR. That's down here. That doesn't look as safe as I would like it to be, especially on a stock that's just, all over the place like that. That seems like an unnecessary risk. And we talk about trading BBAI because, maybe a little bit tighter of a range and a smaller position. When you've got something trading at 30 and you want to sell even just one contract, right? Because we know with BBAI, we're gunning for like at max profit, 150 bucks right there. If you wanted to make $150 on just one contract, where do you have to go on AI? You have to go to 31, where your break even is 30, and that looks way worse on a 1 week perspective, having a break even here versus BBAI, where your break even is going to be down here-ish. So that's kind of my 2 cents on that one. Leaving that alone, a good example of how to evaluate some of these trades. Manchester United, the 21 strike put is very, very interesting. I know they've got some bids open for them, so that's an M&A related type trade. And there's really some nice premium further down here, but that's definitely more of a question mark than a nice fundamental wheel type trade, because you could have M&A news come in the blink of an eye, and that trade is over and done, and if you lost before you could do a single thing about it. As you can see, 180 days ago, this thing was at 10.59, so I just don't like the risk there. Nothing else really standing out to me at the top of this list. I don't know what AMPX is. We could take a look at that one really quickly. But a lot of these are not going to be fundamentally nice trades. It looks like this thing was trading nicely around 6-ish. Can you get anything around 6-ish? The answer, not really. No volume. 7.5 is where you get that 5-cent bid, 15-cent ask. Not a lot of good options there. So we've got 506 different options that meet the criteria we're looking for on a 1 week basis, right? Where we're looking for something that just has greater than 1% ROR. But let's pare this list down a little bit. And one more really quickly is where to go? Redfin, RDFN is on this list kind of interestingly. Massive premiums. That would be because it's basically tripled since the bottom it made in November. These options are offering a decent return, but look, even on Friday alone, it went up 90 cents. If that were to be given back over the course of an entire week, that premium at 8.5 alone would not be enough to save you. So maybe you could play something like Zillow, where there's it's much safer. You could maybe go low 40s, but again, you don't really get that 1% ROR you're looking for. So take that idea out the window. Let's go back to the scan and pare this down a little bit. We want to pair this, if we're looking for a bullish trade, with some oversold stocks, right? If something's oversold, we want to get back in. And there's only one oversold stock right now, which kind of just speaks to how bullish the market has been. And that's kind of what I would expect, right? It's nothing too crazy. Anytime you see the market run up 3.5% in a week and macro trend, right? 3.5% after a week of 1.48%, which followed a week of 1.6%, that's a 6% move in about 3 weeks. You're not going to see a lot on this list. It's good to just hands off, be patient. While you may have a boring week or two waiting for the market to come back to you, I would so much rather miss out on a good trade than be caught in a bad trade. And getting a little bit too aggressive is a great way to be caught in a bad trade. But DPST, let's take a look at it. It's the bull. What is this? Because it's cutting it off. Daily regional banking bull ETF. So it makes sense that something like that would be exposed. Now, I did see an idea like this on Twitter, and I thought it was incredibly interesting. Now, I mentioned earlier I don't really want bank risk. I don't want something like an FRC where this thing could go bankrupt overnight. I don't want like a WAL where this thing could go bankrupt overnight. However, that bankrupt overnight type thing really more so applies to some individual stocks. When you've got a daily regional bull ETF, it's a basket of a bunch of different ones. So what this does, I think it potentially gives you some very decent exposure to the overall basket and the overall idea and the overall volatility that you're seeing right here through this huge spike in IV, which still has some ways to go. But you also, using an ETF, kind of eliminates single bank risk. So I'm going to listen to the devil on my shoulder a little bit here and just take a look at what it's offering, right? So you look at these 7 strike puts, nothing too crazy, right? It's a 3.7% ROR. That's a pretty large number. You could potentially get filled at 25 right here. You go in for 5. These are going to be fully cash secured due to the risk that your broker is going to want. But if you want 125 bucks, that's a 675 break even price on a 1 week basis. We go zoom this in to kind of focus a little bit more on the crisis. 675 would be your break even price on that trade. And 675 falls right here. So basically, you would get this regional ETF at effectively an all-time low, right? We see that it's gone down to 6.5, but very briefly in a pre-market session. So we could potentially have that happen where we have a 4-day trade where it has to go all the way below this red line right here for us to lose any money. We could maybe get a little bit more aggressive with the 7.5 strike put since we have a half size position. Sell 5 of those. Our max profit now jumps up to 225. And our break even is going to be at 705. So instead of here, the break even price is here. And in exchange for that higher break even price, we get a little more potential max profit. And I don't hate that idea at all, to be quite honest with you. So if we potentially think about taking on a little bit smaller of a position, keep it -5. We want to limit those losses a little bit. And DPST, a 4/6 expiry, 7-strike put for 45 cents of premium, and a max profit that's going to bring in 225 bucks. And if you combine that with BBAI, XLK, all of a sudden you start to see these trades adding up to a nicer number on the denominator right here. But again, we don't want to count the chickens before they've hatched or anything, but merely to demonstrate how once you start adding up some of these positions, we don't necessarily want to hit the home run with one of the positions. However, get a lot of diversity in the portfolio, add up some decently smart individual positions, and you could find yourself in a very, very nice overall position. But again, these trades haven't been placed in blue, so we want to keep these as hypothetical trades and not be showing those as any potential profit. So I think that's a decent idea as well. Now, we know that DPST is a little bit riskier of an area. There's not a lot of deep out of the money credit. So what we could actually do is potentially use that to our advantage and maybe create something like a spread. So the issue here is that if for whatever reason this ETF goes bust next week, that would be the equivalent of if the stock literally went to 0, which I don't think is a risk occurring, but I think we could see a risk of a decent sized drop. If you want to save yourself a little bit from that risk, you could turn this into a spread and sell that 7.5 strike put and buy the 6 behind it. So instead of a 45-cent credit, what you're looking at is a 35-cent credit. However, your max loss now goes down to 575. It reduces the amount of buying power, and in turn, technically increases the return you're looking at as well, right? So you're looking at $175 of return off 575 risk, and that's a 30% return in a week on that position. Now your break-even price is going to be a little bit higher at $715, so this is going to have the highest break-even price of all 3 options that we've looked at. However, your downside risk is going to be much lower. The question is just whether or not you feel that that downside risk is something that could potentially be realized. So interesting thing to potentially keep an eye on, and that's going to be 7.5 right there for that 45-cent credit. So I think I'm partial to the 7.5, and I think I'm happy taking a half-size position at like $7.05, especially because next week is a short week in the market. Speaking of things that have dipped a bunch, I do want to take a look at ASTS. Because this one, we had our eye on it previously a good bit. They had some bad earnings and it shot back down. What's a little bit interesting to me is that we've got this big red candle. We've seen some big red candles on ASTS historically, but what we haven't necessarily seen, is a big spike in implied volatility with this candle. Now that comes because they had earnings, so that removes some volatility. But I really expected there to be some more premium on the 5-strike put where you'd have like a 480 basis. Because that 480 basis, if you look at it on a 5-day, chart, 480 doesn't look that great. Yes, it's significantly below where we've seen over the last 5 days, but it went down to 452. And earnings were pretty poor. And a lot of the time you see these earnings, even if it does bounce, you could see a little bit of continuation over day 2, day 3, day 4 post earnings. So keep an eye on this one. And if it gets back down to 5-ish, I think that's potentially a better opportunity to maybe start to reestablish one of those positions at 5. What's FTCH up to? Not much. It was green. Nothing too exciting. But now let's look at it the other way, right? We know that the S&P 500, a little bit scary the way it's been moving. We go to the 1-year basis, boom, things a little bit overbought. So how can we potentially look at some bearish trades? So we go to high, blah, 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 high ROR puts. I know, blah, 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 probably isn't giving you the context you're looking for here. But we go to HT oversold stocks. Excuse me, HT overbought stocks. Getting late. So boom, there you go. We're going to run this again. And instead of one result, I imagine we've got a few more, right? So we've got a lot of stocks that are overbought, and we've got some pretty heavy hitters on this list. Let's kind of pare it down a little bit by sorting by stock instead of individual options, so it's easier to view what our results are. And boom, we've got 5 of them. We've got NVIDIA, we've got Meta, we have Wheaton Precious Metals Corp, Lululemon, and Intel. Now, it's important to think about what these are individually. NVIDIA and Intel are kind of the same trade, right? They're chip makers. So adding 2 of those to your portfolio isn't necessarily giving you any diversity, right? Because it's the same type of thing. Now, Intel sits at 72.74. We can see that number right here when I move the mouse again. NVIDIA sits at 72.68. So very, very similar. On a 1-year basis, NVIDIA is coming back to highs, and it has previously fallen back at 278.34. Some pre-established resistance here, looking at the top of this candle, right about the 288-ish level. So this thing can absolutely keep running and just unabated and have nothing happen to it. Because again, individual stocks are much more likely to kind of ignore the initial thing and just keep screaming upwards. But again, on a 1-year basis, every time we've seen it go red, here's one example, back in mid-November of last year, that corresponded with the peak and it fell back down. We've seen it happen multiple times here, going from the end of January to kind of mid-February. And while it didn't necessarily have a similar move to what it did in November, from where this red started at 190-ish, it kind of made it back, not quite back there, but got down to 204. But you would have kind of gotten crushed a little bit from 190 up to 200 plus. What we had there, though, when it initially was red, what you'll see on the chart is it doesn't really line up with any resistance here. It kind of is halfway through here. You don't see resistance until back here. And, you know, this is why we like to look at charts, right? Because that pre-established resistance over here. Bloody dazzled. Thank you for the thanks for the follow. So we want to have a trade that runs into some sort of resistance and is combined with that high RSI. NVIDIA kind of has it here at 288, but let's look at Intel really quickly to see if we can do something there. Intel, I think we've got some much more established. We don't really have it until 35. Yeah, I mean, this skid from Intel started at 34 and then went down here to 3163, but it already closed above 3163, so I don't see much resistance until we see that 35 number on Intel. And if we take a look at Intel, if we go to 35, we're just not going to see a lot of premium. I'm not a huge fan of what I'm looking at right there from a setup perspective. So NVIDIA seems like a much better idea from a short perspective, but again, as we pointed out on that chart, it can run unabated off that initial, breach above 70 from an RSI perspective. So we want to be cognizant of that and not necessarily sell a naked call off the bat and get ourselves murdered. So what you could do, having identified the fact that 288-ish is about where we think resistance is, you could sell like a 287.5, and that puts you right about there. Shout out to A. Deswell, appreciate the follow. And if you wanted to sell a 287.5 call, it would look nice, right? Because your break-even price because like 288.70, right about where we think resistance is going to be. But look, in theory, your max loss is infinite, and this seems like a trade to me that could absolutely turn into a loser. if it really does start to continue this run. There's not a huge amount of premium. We don't really have this corresponding spike in implied volatility. In fact, it's kind of moving in the opposite direction. So this is one where maybe a wider spread is something that could be a good idea. So maybe something like 285, we go to vertical here. Something like a 285, 290 spread where you get a dollar credit. And I like the dollar credit, but it leaves you, this $4 blank space where you've got 104 in max profit, 396 potential max loss. So it's just one of those trades where I don't know if I necessarily love it, right? We've got a couple bearish trades on already between XLK potentially, and then UVXY and SPXU were locked in. But with the short week, I do want some more positions. So I don't hate necessarily the idea of, doing NVDA. At least thinking about the 285, 290 spread. And if it runs through that, we'll have a 286 break-even price. And then we could then potentially take assignment from there, start selling at-the-money puts. And those at-the-money puts, as it currently sits, offer about $4. So it should be pretty easy to take a short position from about 300-ish and walk that price up there. But it's just crazy what some of these stocks have done, right? We've seen NVIDIA go from 108.13 in October, and it has almost tripled that so far, which is nuts. And I think if we pull up Meta, which was another one from that scan, we're going to see something very, very similar. So if we go to Meta, another potential short idea here as it gets overbought. Now, well, remember, this thing could go much higher. Now, this was earnings driven, so we're not going to have some similar overnight gap risk based off of good earnings. But it's almost tripled again. 88, if it was at $80 a share, triple that to 240. We're coming up on it. But we're now at 70.09. Let's try to identify some areas of potential resistance. This looks like one to me at 223. This looks like another at 200, but again, it blew up through 200, so that's irrelevant for purposes of this discussion. Any premium at 220? Hey, stock market to follow. Can we get any at 220? The answer is not as much as I would like. You'd love to see kind of the 1% ROR-ish, meaning at like a 220 strike, you'd like to see a 220 premium. You get that a little bit closer to 215. So we could kind of try to ride the lightning there a little bit, sell it naked, have a 215, max profit under 215, break even under 217. Let's run the exercise, see what that looks like on like the 1 month chart. And here we go. 215 is where we'd have max profit underneath. 217 would be the break even price on that trade. It's tough. I don't love it. Maybe it looks a little bit better when you zoom in a hair. But again, that resistance we identified is kind of up here. So definitely would want to take a spread in the meantime, right? And we could take advantage of the fact that those 220s don't have a lot of premium on it. We do something very similar to that NVIDIA proposed trade where we take out a 215 and then buy like the 220 behind it in order to reduce our risk a little bit, right? We still would have max profit of 129, max loss of 371. And that max loss of 371, you only hit if it goes up to 220. So I think that's a decent looking trade as well. You could potentially sell a couple of these too if you wanted to buff up that potential max profit. But I like starting small because things can always move against you. And if you're right, you're right. Boom, profit. You probably don't even have to lift another finger. But the idea of the Meta, let's insert another row right here. Basically just the same thing. This is going to be a Meta 4.6, 215, 220 strike call. And we're looking at like a $1.29 of premium on that one. So there you go, another bearish position. We've got some really nice bearish opportunities from this scanner that we've put together, which identifies, stocks that not only have nice premium, but also have this nice intersection of the nice premium and overbought RSI on a 1 year basis. So we could finish out the exercise here a little bit. NVIDIA and Intel, they're very similar. We have a bearish one picked out for NVIDIA, so ignoring Intel. Meta, we just picked one out. Let's look at WPM and then Lulu before we hop off for the night. So WPM is going to be a Precious Metals Corporation. I mean, this is a chart that looks a lot better, right? Where we're looking at something, or I guess when we were looking at Meta, when we were looking at NVIDIA, we wanted it to run into resistance. 51.91 looks like pretty damn clear resistance here. Let's back the chart up a hair. And it runs into it again. And the good thing here is actually, if you look at the current price, where it sits and you extend this line to the left, if I could actually hit the line, you'll see it actually runs into resistance from, May, June of 2021 as well. So we're now potentially working with 2 points of resistance. Now, this is a stock that has traded in kind of a tighter range over a 3-year basis, so I don't imagine the premium is going to be through the roof here or anything like this. But regardless, oh yeah, the premium is kind of horrid, to be honest. So what you could do here, since it is a little bit overbought, is again start with the spread, right? It kind of sucks that the premium sucks, but when it's that bad, we want to use a spread to take advantage of that. So we know that there's a lot of premium right at the money there at 48. We know that there's not necessarily a lot right there at 50. So what you could do is open up a vertical spread, 48 short leg, 50 long leg, maybe cut that down to like 5. And what you end up with is like a 50% return on risk position that makes money anywhere under 48.65. And again, so if we zoom this in, anywhere under 48.65 is where this makes money. And 48.65, that's on the other side of that resistance that we identified. That could potentially be a decent trade. Now remember, this thing ran up $3, or excuse me, like $2 in a week. So there's definitely some risk that it can run up to 48, but there's some decent ways to combat that as well. So love the idea of the 48.50 call credit spread right there. So that's potentially on the radar as well. Lulu's the last one, Lululemon. We'll see that that one's also overbought, not quite as overbought as it needs to be, and this is overbought mainly because of earnings. So this isn't necessarily one that we would want to target as just kind of a natural mover that's run a little bit too hot. There's a reason this one's run hot, so I think we'll leave that one alone. But from where it currently stands, we potentially could go to the watch list on Monday. I'm partial to the fact that, look, futures are red. I can almost guarantee you there are going to be some stocks that are red on Monday, and then we could add intra-week to some more bullish positions. But as it stands right now, 5 potentially bearish positions outlined. These 2 aren't necessarily correlated to the market, so I'm kind of ignoring those for purposes of this. But only 2 bullish positions, so we want to have some placeholders. And, these placeholders we have right here, the TBD, I want these to be bullish positions. But nothing looks great. And, again, the biggest thing that I would say as we wrap up the stream, go back to full cam as we kind of talk about this, is it's so much better to miss out on what might be a good trade than get stuck in a bad trade. The market has run up 6%, meaning the S&P 500. NASDAQ's done even more. But it's run up 6% in the last 3 weeks. We know that the average return in the S&P 500 on a yearly basis is between 9 and 10%. So moving up 6% in 3 weeks as compared to 9 and 10% in 1 year, that's obviously outpacing the typical pace. So we don't want to get too aggressive. I've made the mistake before, and I've seen countless other people make the same mistake of jumping in and scaling in when the market's getting hot. And then when it inevitably pulls back down, whether that's here or whether it's 10 points higher, we don't know. Because if we knew, quite honestly, we'd be all in on a spread and we would make a ton of money if we knew what the market was going to do. But the best thing we could do is make educated guesses using some technical analysis items like RSI, and using those to guide our decision-making process. So that's what we've got, right? We're on a really nice 2-week stretch where we've taken home just a hair under $5,000. After Q1, we're outperforming the S&P 500. We're underperforming NASDAQ, but that's really more in part due to the overperformance of NASDAQ, as it's up like 16% in a quarter. We never want to rely on that. So we kind of want to run our own race right now. We're never going to be upset with the fact that we've returned 8% in a quarter, because if we do that every single quarter and we return over 30% a year, we'll be some of the best traders on planet Earth, to be quite honest. Quick question in the chat: do we trade futures as well or just options? We are mainly just option sellers. Every now and then, if I get bored, I'll dabble in futures, but the bread and butter, what we do, the strategies that we develop and teach are all going to be option selling strategies, which have historically done great and still have performed well this year. Even if we're still trying to chase NASDAQ, we're still outperforming the S&P 500. I think we're good with where we sit. But that's all we got, right? We've got a few ideas. I think next week, even though it's a short week with the market closed on Friday for Good Friday, keep that in mind, is going to be a little bit more of a react type week. I definitely could be on board with adding an XSP strangle, but the market was running so hot at the end of the day on Friday that probably best to just take the hands off, let it settle somewhere, and then come back in Monday where you could find similar premium but have a little bit more stable of an idea as to where the market would be sitting. But that's all we got for this time. Until next time, this has been the Hourglass Trader, where as time passes, we make money, and hopefully we'll talk to you guys again same time next week with a little bit more money in our accounts than we have right now. Thanks again so much to all of you who have been tuning in week after week. I know we took last week off because of vacation, but we are going 2 in a row. We will be on same time next week. I can guarantee you that. So until next time, we'll be in the Discord server, hourglass-trader.com. Hit that big purple button in the middle if you want to join. As always, free to join and learn the strategies. That's the goal of what we do here. There's so much bad information online that we want to avoid and get ourselves into a good, consistent, safer, long-term strategy, as opposed to trying to take the shortcut in the market and, make some astronomically large gain in a short period of time. You are always going to be better served with safe, consistent, and profitable trades over a longer term basis. So that's all we got. Until next time, I have nothing else to say. I probably need a better catchphrase at the end of these, but see you guys.